Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician, also Portfolio Manager. I also want to just say thank you to all you who came to the third lease, and especially the chance to meet several of you, and know there's several regular viewers I hadn't had the chance to meet, and so it was nice to meet you, and if you're one of those, I do thank you for introducing yourself. We do have a couple of topics to talk about this week, two that we're going to share via the slides. We'll talk about corporate debt and its significance, and then seasonality, favorite topic of Andrew's, something that's always interesting that it's lasting through time, at least since I've been in the business. So let's just start off with the corporate debt. So we're going to take a look at what is known as issuance. So in any given year, there's new bonds. All right, so in corporate bonds, that's just one thing to keep in mind. When corporate debt, like unlike you and I, typically over our lifetime, we'll accumulate debt and then we'll pay it down. For corporations, they're much more about issuing new bonds to pay off old ones. All right, that's okay and that's healthy. Debt used in the right amounts, all right, can be an effective tool for business, especially since interest is tax deductible. But that being said, so here's a list year by year of corporate issuance. And the thing to point out is that in 2020 and 2021, there was a lot of issuance for corporate debt in the U.S. And so if you think about the significance, if we travel back in time to those years, interest rates were incredibly low. So many businesses in the country did a great job of going out to lock in low rates. Many like you and your kids or grandkids did with their house and locking in and refinancing debt. So this is a good thing. This is one reason why we've seen, even though interest rates moving up, not a lot of panic or run for the exits for corporate bond owners who are worried about this money being due and being refinanced with higher rate bonds, because a lot of this money was locked in. So this will definitely be something that stays with us, unlike you and I with our mortgages, which are typically either at least 15, if not 30 years. Corporate bonds, especially of the riskier variety, are shorter term in nature. So if we go out a couple years, a lot of these that were issued become due. And if we're in the same rate environment, then as of now, we will certainly be having a noticeable uptick in bankruptcies and defaults. So we'll be just mopping and watching the time between now and then. So I want to pass the ball over to Andrew. We have been going through a pullback here, and I know Andrew, a couple of weeks ago, had showed that this right here, the last 2 weeks of September and the first 2 weeks of October, noticeably more choppy. So I think it's really no surprise. If anything, from my seat, maybe even a little tamer than usual. So I think people like to hear what you have to share here in a different vein of seasonality.
Thanks, Adam. So seasonality has been, as Adam said, it's been a topic we've been discussing for several weeks now. We came into August. I think we also talked about seasonality then, that August had been kind of a rough month for equities. In September, not out of that picture as well. September's been pretty hard for equities as well, and 2023 has followed that picture. We've looked at different versions of seasonality on the Market Carver, as well as intensively in our weekly allocation meetings, looking at annual seasonality, monthly seasonality, and getting down to even looking at pre-election seasonality. And that's where we're going to spend our time today. What I plotted on the chart that's on your screen right now is looking at every pre-election year going back to the early 90s. And then the current year is the black line there. It says we are here. That's been the current year. You can see we've been pulling back for the last 2 months. And that's pretty well tracked the seasonal pattern for pre-election years. Where the news starts to improve is towards about early mid-October. In pre-election years, we start seeing the market begin to rebound. They've often had this pullback that we're pretty much has been pretty normal for a pre-election year that we've been experiencing so far. And by about the late second week of October is when they start to show increase. Seasonality begins to improve. I've put black arrows on the prior years where you kind of see those years start to bottom and begin to rise by varying degrees into year end. Now, of course, there's the important caveat we must always mention that just because there's a seasonal pattern doesn't mean we need to follow it. So far, the market has done a pretty good job of following seasonality for this year, as well as for the annual pattern and the pre-election pattern. But it doesn't mean it's required to follow that into year end. Now, we do have hopes that it does, as we do would love to see a bounce higher and close out on a strong note, a positive note for the year end. But it is something to start looking forward to see if the market does begin to follow that path. It's important when we do see the market break away from seasonality. If we do see these patterns that typically start to rally and the market does show weakness, that's as just important of a signal to us as portfolio managers and analysts to recognize. And so we want to be cognizant of how the market acts at these important seasonal turning points and see how the sentiment, see how the supply and demand of the market is acting at those times. Now, at the same time, we know the market is like we said, it's experiencing weakness. We peaked back just coming into August. It's been declining since then for August and September after having a very, very strong first part of the year. And now we're seeing some more volatility as we start discussing the possible government shutdown that may happen this week. And when we open up our history books and look at the past times we've had government shutdowns, thankfully there's not too many of them, but it has been something we've had to deal with in the past. The market actually has been able to take those steps in stride, recognizing that they are typically very short term, and it's able to digest that information pretty quickly. And the market's response from a performance standpoint has actually been net positive on average for all the different government shutdowns that we've had. So while we do understand that this is something that's going to be big in the news, you'll see the headlines. As far as the market's concerned, it's definitely much more forward looking, recognizing that it's likely to be temporary, a lot of political noise, and it's not something that has had a longer term impact when we start looking months out rather than just trying to look at the next couple of days. So we are positive on that aspect, that typically government shutdowns aren't overly market impacting in the longer term, as they much are, and they may be in the intermediate day-to-day swings of the market and the noise of the news. So hopefully that helps provide some clarity to what's going on with seasonality, what's going on as far as the market and the government shutdown. And again, I'll echo Adam's sentiment. Thank you again for definitely coming to the third lace.
Absolutely. Yeah, I couldn't agree more. Very well said, Andrew. It's always disturbing. These threats are the reason we had a debt ratings downgrade, much more than the absolute level of the debt. So it'd be really comforting if we could at least get everybody on the same path. And that's both sides of the aisle. So with that being said, you covered it well, and I couldn't agree more. And I do want to thank all of you for joining us. As always, give you a reminder to give us a call if we can be of help, 800-928-4001, or scan the QR code and book electronically. So thanks again, and have a great weekend.